Pause. Welcome to episode 1. This is a discussion of Chapter 1 of UAE Crypto Litigation, available at www.uaecryptolitigation.com. Okay, let's dive in. We're looking at a really foundational issue from the, let's say, earlier days of crypto assets, specifically these informal over-the-counter OTC deals, where significant amounts of regular money, fiat, were transferred, often based on maybe just a chat message expecting crypto in return.
Right. And that informality, it created a massive amount of risk. Because when disputes arose, and they often did, the courts had this fundamental question. What exactly was this arrangement legally? Was it agency, investment management, or just, simple purchase?
So our mission here is to understand how the UAE courts navigated this, how they looked beyond the tech, the sort of crypto aspect, and applied basic commercial law principles to figure things out. How do they characterize these, well, ambiguous transfers?
And a really good starting point is a key judgment from the Dubai Court of Appeal back in 2021. It sheds a lot of light. The case involved someone, the claimant, who sent a pretty substantial amount of money over several transfers, actually, to another party, the defendant. The clear goal was buying digital currencies.
And the claimant's argument was this wasn't just a straightforward buy-sell. They claimed it was more like an agency relationship, maybe even investment management. They thought the defendant was meant to set up a specific trading account just for them.
But that didn't happen, apparently.
Yeah.
The defendant received the funds, but then allegedly mixed them into their own accounts, citing difficulties actually making the trades.
Okay, so some money was returned, but a large chunk remained in dispute. Now, you mentioned the journey through the courts was interesting. The first court actually dismissed the case.
That's right. The court of first instance dismissed it entirely, which, forced the claimant to appear and essentially rethink their whole argument for the Court of Appeal.
And this is where it gets particularly insightful, right? The appellant, the claimant, wanted the court to look closely at digital evidence WhatsApp messages, I think, to prove this complex agency relationship they were arguing for.
Exactly. They wanted to authenticate this whole transcript.
Yeah.
But the Court of Appeal made a really decisive procedural move. Instead of getting bogged down in analyzing messages, they appointed a court-recognized accounting expert.
Ah, so shifting focus immediately.
Precisely. Before even ruling on the legal nature of the relationship, they said, let's follow the money. The expert's job was to trace the flow of funds. This totally changed the game, moving away from subjective interpretations of chats towards objective financial facts.
So less about he said, she said from the messages, and more about where the dirhams actually went. The expert's report then became central.
It became the bedrock of the decision. And this aligns with established UAE court practice. The court has full authority to assess and adopt an expert's report if it finds it sound. It can effectively override the parties' competing claims based on that expert analysis. It's a way to cut through complexity.
Right, makes sense, especially when the underlying facts might be, well, messy. So after the expert traced the money, what was the final conclusion? What did the court decide this relationship actually was?
After all the arguments about agency and investment, the expert and the court agreed, boiled it down to the most basic commercial form, a simple contract for the sale of goods.
Really? Just sale of goods?
That's it. The claimant was the buyer, the defendant was the seller, and the cryptocurrency was the good being sold.
Wow. So all that complexity about fiduciary duties and managing investments essentially dismissed in favor of you paid for something, you didn't get all of it.
It's a classic example of substance over form. The court looked at the core economic reality. The breach was simple. The seller took the money but didn't deliver the full quantity of the goods, the crypto.
And the outcome reflected that. The initial dismissal was overturned.
Yes, the Court of Appeal set aside the first judgment. It ordered the respondent, the seller, to pay back the outstanding balance.
What about damages or interest? The claimant must have asked for compensation for the delay.
They did. They asked for 9% interest, but the court applied its standard rate for commercial debts, awarding legal interest at 5% per year. Critically, this was calculated from the date the lawsuit was filed, not from the date of the original transaction.
Okay, and framing it as compensation for damage due to delayed payment reinforces that finding of a straightforward debt from a broken sale, right? Not, say, lost investment profits.
Exactly. It underscores the court's focus on applying fundamental commercial law principles, providing a degree of legal certainty even when dealing with novel assets like crypto. For more details on the case specifics, you can find them in the book UAE Crypto Litigation, available at www.uaecryptolitigation.com.
That clarity on how the courts handled past disputes is useful. But, as you said, the landscape has changed dramatically. Let's connect this to today. If a licensed virtual asset service provider, a VASP, were in this situation now, what are the key regulatory differences? What must they do?
Oh, it's night and day. The current regulations, whether from VARA in Dubai or the SEA federally, are far, far stricter. They're specifically designed to prevent exactly what happened in this case. The absolute number one issue here was the commingling of funds.
The defendant mixing client money with their own operational funds.
Correct, and that is now fundamentally prohibited. The principle of asset segregation is paramount. Client fiat money must be held in a designated client account, usually at a third-party bank, completely separate from the VASP's own money.
That's a critical protection for clients.
It absolutely is. It ensures that if the VASP itself faces financial difficulty, the client funds are ring-fenced and protected.
Okay, that covers the fiat side. What about the failure to deliver the crypto itself, the execution failure? How do regulations address that now?
Licensed VASPs take on execution liability. The rules, like VARA's, are very clear. The VASP is responsible to the client for ensuring the correct and successful transfer of the virtual assets to the client's designated wallet.
So they can't just blame the blockchain or a wrong address?
Not easily. They have a duty to ensure settlement. If something goes wrong, they need to investigate, trace, and fix it. And importantly, they must provide detailed confirmation receipts afterwards, showing transaction IDs, amounts, everything, proof of completion.
Which brings us to record keeping, I suppose. The lack of clear records was a big issue in the case.
A massive issue. And now, mandatory record keeping is non-negotiable. VASPs have to maintain incredibly detailed audit trails for every single transaction. Who, what, when, where, how much, fees, wallet addresses, everything. These records have to be kept for years, typically at least 8 years under VARA rules.
So the courts wouldn't need to rely solely on an external accounting expert today. The VASP's own records should provide that trail.
They absolutely should. The records must be sufficient for regulators to audit and verify compliance at any time. The lack of such records in the early OTC days is precisely why the court had to take the approach it did.
And there's also the technical side, right? Secure custody and transfer protocols.
Yes, technical compliance is woven throughout the regulations. Things like area's custody rulebook detail requirements for secure wallet management, hot and cold storage policies, queue generation, multi-sig security, cybersecurity standards. A failure to deliver assets would likely trigger scrutiny of whether these technical standards were met.
Okay, so the judicial approach was pragmatic, find the simplest commercial reality. The regulatory approach now is prescriptive, segregate, document, execute properly. So for businesses operating now, how do they avoid these problems altogether? How do you prevent the ambiguity that leads to disputes?
It really boils down to robust contractual architecture. That case we discussed essentially arose from a vacuum of formal agreement. The antidote is clear documentation, comprehensive master agreements covering the overall relationship, supplemented by specific, standardized confirmations for every single trade.
Moving from informal chats to legally solid paperwork.
Exactly. This structure immediately clarifies whether the relationship is principal to principal, like the court found, or agency. There's no room left for argument later.
And how detailed should these agreements be about the trade life cycle itself?
Very detailed. The master agreement should map out the entire process, how an order is placed, how it's accepted, what constitutes a binding trade, and critically, the format and delivery method for the electronic confirmation. That confirmation needs to lock in all the key terms, the asset pair, price, quantity, execution time. It turns a maybe into a definite obligation.
You mentioned segregation as a regulatory must. Should that be mirrored in the contract too?
Absolutely. The contract should explicitly require segregated accounts and wallets, reinforcing the regulatory duty. And for larger or more complex deals, using escrow arrangements is a smart move.
Holding the assets or funds with a neutral third party?
Correct. The escrow agent only releases the funds or assets when they receive explicit, verified instructions from both parties. It's like a contractual multi-sig, preventing one party from acting unilaterally.
What about defining when a crypto transaction is actually done? Settlement finality can be tricky.
The contract needs to define that objectively. It could specify, for instance, that settlement is deemed final only after a certain number of blockchain confirmations for that specific crypto asset. Or for some assets or counterparty types, it might rely on attestations from agreed-upon custodians. The key is making it verifiable and unambiguous in the contract.
And lastly, you mentioned the court appointing an expert. Can contracts preempt that?
Yes, and it's a really good practice. Parties can proactively appoint a neutral calculation agent within their master agreement. This agent is given the authority, by the contract to determine things like valuations, mark-to-market amounts, or termination payments if disputes arise.
And you pre-agree on how they'll calculate it?
Critically, yes. The contract must specify the exact data sources, which exchanges, which indices, what time of day, and the methodology the calculation agent must use. This removes subjectivity and drastically reduces the scope for valuation disputes down the line.
So, wrapping this up, the key takeaway for you, the listener, seems to be twofold. First, in undocumented historical disputes, UAE courts applied foundational commercial law, often simplifying things to a sale of goods based on tracing funds. Second, looking forward, the regulatory environment for licensed VASPs is incredibly rigorous, demanding segregation, execution responsibility, and detailed records, all of which should be underpinned by strong contractual frameworks.
And the author of the book provides a bridge between this chapter's findings and the next legal problem to be explored. The court's classification of an undocumented over-the-counter crypto asset purchase as a simple sale of goods provides a clear, if rudimentary, analytical framework for resolving disputes in the absence of a specific regulatory regime. It demonstrates a judicial willingness to look past technological novelty and apply foundational commercial principles to the core actions of payment and delivery. This approach provides a degree of legal certainty for participants in straightforward peer-to-peer transactions. However, not all crypto asset arrangements fit this mold. It is common for capital to be provided to third parties under ambiguous terms that blur the line between a simple creditor-debtor relationship and a shared risk investment partnership. The subsequent case analysis will explore this ambiguity, demonstrating how the judiciary dissects prior judicial admissions to determine whether a transfer of funds constituted a personal loan with a defined repayment obligation or a speculative capital contribution to a volatile digital asset venture.
That brings us to the end of our discussion on Chapter 1. This chapter's structure framing the problem, analyzing the judgment, considering the current regulation, and providing practical mitigation is the standard methodology used throughout the book.
Authored by Mahmoud Abuwasel and drawing on analysis from over 100 judgments, UAE Crypto Litigation serves as an indispensable resource for those in the digital asset industry.
To read the full analysis for this chapter and to explore the complete 7-part life cycle of a commercial dispute covered in the book, please visit www.uaecryptolitigation.com.
The discussion in this podcast is for educational and informational purposes only and does not constitute professional advice or any other professional relationship. Please consult with a qualified professional for advice tailored to your specific situation.